Welcome back to another Tech Talk from MarketEdge.com, your source for unbiased technical stock research. With me today is David Blake, CMT, here to discuss last week's market and what we should look for as we head into this week. David, how are you doing today?
I'm doing well, thank you.
Awesome. Let's jump right in.
All right, we're actually starting the third week of some pretty exciting market stuff. Last week, coming off the best week since early November, we saw the major averages ease into the week. They're looking at a possible ceasefire deal between the U.S. and Iran. And when they finally got a little bit of confirmation on that, the market just took off. The Dow was up 1,300 points on Monday. Oil prices dropped about 15%. And that was actually the best single session daily point gain for the Dow in almost a year. Now, along with that, we had the Dow Jones Transportation Index and the Philadelphia Semiconductor Index both rallied. Actually, they rallied to new highs. And in fact, the Semiconductor Index was up 6.34% on that Wednesday alone. I think for the week, it was up about 13.5%. So these are big, big moves, as you can tell when you listen to the people in NVIDIA or Broadcom start to talk, or Meta. They're talking that they're going to need millions and millions of chips to run these AI centers. So the semis keep going. I think they're getting close to getting a little bit overbought at this point, but I think I would be buying the semis as they kind of pull back. So that's something to take a look at. Last week's rally also was pretty much across the board. The energy sector retreated about 3.9%, but every other sector had strong gains. We had tech and industrials and consumer discretionary. They were up more than 4.4%. Yields were a little changed. The yields are going to have a little bit of a struggle because they're seeing this oil pricing as inflationary, yet at the same time, that higher oil prices are going to weigh on the global economies, and that's going to slow growth. So they're looking at the slower growth, yet rising prices, which is stagflation. That's something that they're going to struggle with probably for a while. And in fact, the April FOMC meeting is the last week of April. And right as of yesterday, it was a 98% probability that, again, they'll leave rates unchanged for that. They just have to let some of this stuff play out for a little bit. Okay, we did get some inflationary data last week with the March CPI. The headline was up 0.9% and 3.3% year over year. Today, we actually got the CPI came out, and it was up. CPI was up 0.5% for the month. They were expecting 1.1%. And then the core PPI was also up 0.5%, and it was up 3.8% year over year. The headline March PPI was up 4% versus 4.6% year over year, which was the estimate. And for some reason, people kind of celebrate that a little bit, but that's something that we just have to let play out here. But the market responded to that, to the upside. We also got good news today that the U.S. and Iran reportedly are going to commit to another round of talks fairly soon. So that's putting some more downward pressure on oil prices, and global markets are again rallying to start the week here. This week, we're going into a big week of earnings. We got the money center banks reporting yesterday and today. Goldman Sachs came out, a good solid report, but they were a little bit light on their fixed income revenue, which left the stock kind of flat. Today, we got strong numbers from, JP Morgan. They blew out their numbers. And we had Citigroup and Wells Fargo also beat that. So that's good for the banks. CarMax disappointed. It traded lower. So watch that. Other economic data today was the small business optimism index fell 7 points to a one-year low. So that's a little bit funny to watch. We also saw, it's funny because the transportation index is down today, yet the airlines are flying because there's reports that American Airlines may merge with United Airlines. So that's sending them all up like 9 or 10%. But the index itself is kind of moving down. So anyway, just to review what's going on technically, the major averages are all now above their key moving averages, like the 200, the 100, the 50-day moving average. Momentum looks strong right now. It's improving with the 14-day RSI, MACD have all clicked over into positive ground. I noticed yesterday that the NYSE AD line, let me see if I can pull that up over here. The market at a glance. Of course, you can get all these things we talk about. But the NYSE line, which we consider a leading indicator of market direction, is very close to making a new high. As you can see like this, we have another day or two of that. That'll just show you that the majority of stocks are under accumulation. And that probably means that we continue to move higher. And in fact, I believe we're almost back to reclaiming the whole, if you look over the NASDAQ and the S&P, the whole sell-off that we had from the Iran war thing here. So we're very close to that. That's also a positive. Again, we're seeing the gains across the board, except for energy, which needed to pull back a little bit. So that's all good. I said it last night in the daily comment that we're seeing strong upside momentum. People are jumping back in. They're hoping this Iran-U.S. thing gets settled sooner than later. At some point, we'll see a deal come through, and that's going to be good for global equities going forward. Now, another thing we saw yesterday, which was noticeable, you've been hearing a lot of talk about private equity having problems because they're so invested in software companies. Well, now you're starting to see comments from Goldman Sachs and some of the other groups that perhaps the AI disruption with software may not be as bad, or it'll take longer to play out. And so you saw a pretty nice move in the private sector stocks yesterday. That's Apollo and BlackRock. Yeah, they were all up about 5 or 6%. That's nice. And then you also saw the IGV, which is the tech software ETF, which has been hammered. It made a new low, I believe, early last week. It was up about 5%. You had stocks like Microsoft and Oracle, Palantir, big moves yesterday, and they're rallying again today. Just comments from analysts that sell-off is overdone, and that they're down 25, 30%, some of those stocks, and you don't get a chance to buy those at that deep of a discount very often. So that might be something that you want to look at. I see a lot of people are thinking here, we've had such a run up in energy, oil related stocks, that it might be time to lighten up on some of those. They're starting to pull back. There's always the headline risk that we could jump up, and with oil going up to about $130 or so. But at this stage, they're not counting on that. And you're starting to see it just gradually come down a little bit. We'll see how that plays out. But I would consider possibly taking a little bit of money off the table on some of your oil related stocks. So just to kind of wrap things up here a little bit, we have leadership by the small caps and the transportation stocks, and also the semiconductors. I always refer to those as the secondary indexes in the market letter. And again, they are outperforming, and 2 of the 3 are making new highs. That's a plus for the market. Market technicians like to see those indexes lead the market higher and lead them lower. And this case is playing out just like you'd want it to, with those 3 indexes punching out the new highs. And I think we'll see all the indexes at least make a run here over the short term. So bottom line, I think that if the market's been down here, it's bouncing back pretty quick. You might want to look at some of these big stocks that have had the corrections, like the Microsoft and that type of thing. The Mag 7 stocks are again leading the market higher. Some of the cyclical stocks still look good. The bank stocks still look good. You might consider beginning to add to those positions. Also, sentiment in the index on sentiment is down. Was it 2? It's already a 1 this week, which means we're at a very neutral position. You had the NAIM, which is the money managers. They had fallen from about 98% exposure to equities in the market all the way down to about 67, 68%. That was the lowest since last year anyway. And last week they added a little bit more, but they're still only at about 69%. Normally you're going to see that push up to about 80 some percent. And that just means that's a lot of money going into this market. And that buying pressure is going to probably keep the upward momentum going fairly strong for the rest of this week. You also saw the retail client that they're almost back to the historical average, but you'll start to see the retail clients start to move back into stocks too. Again, a lot of money. They make a much bigger percentage of buying power than they used to. So at this stage, you've got a lot of good stuff that's coming out. You talk about stocks climb the wall of worry. That wall of worry is crumbling in here right now, which probably will lead us to another little bit of a run to new highs. We'll have to see how that plays out. There is a little bit of headline risk still with the war going on, and that would probably keep me from jumping in 100% at this stage. I think you want to have a little bit of dry powder and maybe nibble away at the drawdowns or sell-offs a little bit and buy the dips. And the rest of the week, we have not a lot more economic data. So we have Empire State Manufacturing Index. We have import and export prices coming out, the jobless claims, the Philly Fed Index, industrial production, that kind of stuff. A full slate of earnings coming down the pike. So far, everything looks good. So I don't imagine we'll see many surprises, and that should probably keep a nice little floor under the market. a lot of times you'll have some warnings from the analysts going into earnings, which they start to cut back on earnings estimates and that kind of thing. And we're not really seeing that this quarter, which means that we're probably going to see solid numbers going forward, which should keep the floor into the market going forward.
All right, very good. Thank you, David. If you have questions for David or anyone else on the MarketEdge team, send us an email to support@marketedge.com or drop a comment below if you're watching on YouTube. Your 2-week free trial of finished technical stock analysis on over 5,000 stocks and ETFs is at marketedge.com. All right, we'll catch you next week. Thanks for watching. Don't forget to like and subscribe. Thanks, David.
Okay, kiddo. Bye.
Bye.